Long ago, people did not have money. They traded things, grain for meat, cloth for tools. But as life became more complicated, people needed something easier to exchange. This is how money was born. In Money, Jacob Goldstein tells the fascinating story of how money changed the world. From ancient coins to digital currency, he explains how money shaped economies, societies, and even our daily lives. The book is not just about history, it helps us understand why money works the way it does today. If you've ever wondered what money really is and why it has power, this book is a great way to find out. Chapter 1: The Invention of Money. Before money came into existence, human societies relied on bartering, a system in which people exchanged goods and services directly. If you had something of value, like grain, and needed something else, like a tool, you would have to find someone who wanted grain and had the tool you needed. This system worked in small communities but became impractical as societies grew and trade became more complex. Bartering required a double coincidence of wants, meaning both parties needed exactly what the other person had to offer, which was often difficult to find. As human societies developed, the need for something more efficient became clear. People started using objects that had inherent value, such as cattle, grain, or shells, to facilitate trade. These early forms of money made transactions easier, but they still had limitations. For instance, livestock could be hard to transport, and grains could spoil. Over time, civilizations began to use more durable materials like metals. These materials were valuable, easy to carry, and could be divided into smaller units, which made trade simpler and more efficient. Eventually, this idea of money evolved into the coins and paper currency we use today. But it all started with the need to solve the inefficiencies of bartering. The invention of money was a game changer. It allowed for more complex trade, supported the growth of economies, and laid the foundation for the modern global economy. Chapter 2: Why the Lydians Matter. The Lydians, an ancient civilization located in what is now Western Turkey, made a crucial contribution to the development of money. They were the first to mint standardized coins around 600 BC. Before the Lydians, people used a variety of goods as money, like gold, silver, or grain. However, these were not standardized, meaning their value could vary based on weight or quality. Transactions were often slow and complicated because people had to measure and agree on the worth of these items every time they were exchanged. The Lydians changed this by creating coins made of precious metals, specifically gold and silver, that had a set weight and value. These coins were easy to carry, durable, and universally accepted. Their design meant that everyone could trust their value without needing to measure them each time. This standardization was revolutionary. It made trade more efficient and allowed economies to grow beyond the local level. Coins enabled merchants to trade over longer distances, and soon other civilizations adopted this idea, creating their own coins. The Lydians' introduction of minted coins laid the groundwork for the global monetary system we rely on today. Their innovation wasn't just about convenience, it represented a shift in how societies thought about money and value. Before the Lydians, value was tied to physical objects like livestock or grains. With coins, the concept of money became something more abstract, representing a standardized unit of value that could be used in any transaction. This simple yet groundbreaking idea was the first step toward the complex financial systems we use today, and the Lydians' legacy is still felt in the coins and currencies of modern economies. Chapter 3: Kublai Khan and the First Paper Money. The story of money took another major leap forward during the reign of Kublai Khan, the Mongol emperor in the 13th century. While coins and metal money had served their purpose for centuries, they had limitations. They were heavy to carry in large quantities, and transporting them over vast distances was challenging. Kublai Khan, wanting to improve trade across his empire, decided to introduce a new kind of money: paper currency. This was a radical idea at the time, as paper was not traditionally seen as valuable in the same way as gold or silver. However, the Mongol Empire had control over large regions, and Kublai Khan's government could back the value of the paper money with trust and authority. He created the first state-backed paper money, which was backed by the Mongol government and could be used for transactions across the empire. This move made trade far easier and more efficient, as people could now carry large sums of money without the weight and risk of transporting coins. The introduction of paper money allowed merchants and travelers to move through the empire with ease, fostering economic growth. It also influenced the development of paper currency in other parts of the world, paving the way for modern forms of money that we now use in our everyday lives. Kublai Khan's invention was not just a financial tool, it was a game changer that helped to unify and strengthen the empire. Chapter 4: The Birth of a Bank. As economies grew and trade became more complex, the need for institutions that could help manage and store money became increasingly important. This led to the creation of the first banks. The idea of a bank, an institution that could hold and lend money, emerged during the 12th century in Italy. Italian merchants and traders dealing with long distance trade needed a safe place to store their money. They also needed a way to exchange currency, especially since different regions had different coins and systems of money. The first banks were set up in Italy by families such as the Medici, who understood the need for a central place to manage the growing wealth from trade. These early banks allowed people to deposit money, take loans, exchange foreign currencies. They also invented a new system of bookkeeping, using ledgers to record transactions, which made managing money and credit much easier. Banks allowed merchants to travel across Europe without having to carry large amounts of cash. They could deposit money in one bank and withdraw it in another, making trade more efficient. The creation of these early banks laid the foundation for the banking system we rely on today. As they grew, they started offering more services like loans and credit, which helped fuel the expansion of economies. The birth of banking was a key development in the history of money, and it opened the door for modern financial systems to emerge, making it possible for the world's economies to function on a global scale. Chapter 5: The Invention of the Dollar. The dollar, as we know it today, has a rich and fascinating history that traces back to the 16th century. It all began in Europe when Spanish silver coins, called pieces of eight, became widely used in international trade. These coins were valuable due to their high silver content, and they became a standard form of currency used across Europe and the Americas. In the American colonies, these coins were often used for transactions, and they were so trusted that they influenced the creation of the US dollar. The US government, upon its formation, needed a currency system that could unify the growing nation. In 1792, the US Mint was established, and the first official US dollar was created. The new dollar was based on the Spanish pieces of eight, using a similar silver standard. It was intended to be a stable and reliable currency that could support trade and economic growth across the United States. Over time, the dollar became the standard currency for the nation, and its role in global trade expanded. The invention of the dollar wasn't just about creating a form of money. It was about establishing a financial system that could unite a country and give it a strong presence in global markets. Today, the dollar remains one of the most influential currencies in the world, a testament to its historical roots and the impact of its invention. Chapter 6: The Gold Standard and its Discontents. The gold standard was a monetary system in which the value of a country's currency was directly tied to a specific amount of gold. This system was widely used throughout the 19th and early 20th centuries. Under the gold standard, governments could only issue as much currency as they had in gold reserves, making the system relatively stable and trustworthy. The idea was that gold had intrinsic value, and linking currency to it would prevent inflation and ensure the money supply remained stable. However, while the gold standard helped create stability, it also had significant drawbacks. It limited the flexibility of governments to adjust their money supply in response to economic needs. If a country faced a recession or financial crisis, it couldn't easily print more money to stimulate the economy unless it had enough gold to back it up. This caused problems during times of economic hardship, as governments couldn't act quickly to address issues. Additionally, the gold standard led to economic inequality, as the supply of gold was limited, and some countries, like the United States, held more gold than others, giving them an unfair advantage. As the world entered the 20th century, the limitations of the gold standard became more apparent. During the Great Depression in the 1930s, many countries abandoned the system because it made it harder to recover from the economic crisis. The US officially left the gold standard in 1971, shifting to a fiat currency system, where money is not backed by a physical commodity like gold, but rather by the government's trust in its value. Despite its collapse, the gold standard's legacy remains significant in the world of finance. It showed the importance of backing currency with something of real value, but also highlighted the challenges of maintaining such a rigid system in a rapidly changing global economy. Chapter 7: A Bank for the United States. In the early years of the United States, the country faced a major challenge: how to establish a stable and reliable financial system. The young nation was burdened with debt from the Revolutionary War and lacked a central authority to manage its finances. To solve this problem, Alexander Hamilton, the first Secretary of the Treasury, proposed the creation of a central bank that would help manage the nation's finances, regulate the money supply, and provide a stable currency. This idea led to the founding of the first Bank of the United States in 1791. The bank was designed to serve as the government's financial agent, providing loans to the government, regulating state-chartered banks, and issuing paper money. It would also help establish the nation's credit and strengthen its economy. However, the bank faced fierce opposition, especially from Thomas Jefferson and his followers, who believed it gave too much power to the federal government and favored wealthy elites. Despite this opposition, the bank helped stabilize the U.S. economy and played a crucial role in the country's financial development. Its charter expired in 1811, but the idea of a central bank persisted and would eventually lead to the creation of the Federal Reserve System in the 20th century. The first Bank of the United States was an essential step in the evolution of America's financial infrastructure and helped lay the foundation for the modern banking system. Chapter 8: The Rise of Wall Street. Wall Street, today the heart of global finance, has a history that dates back to the late 18th century when the United States was still in its infancy. The story of Wall Street's rise as a financial hub begins with the establishment of the New York Stock Exchange in 1792. At that time, traders would gather under a buttonwood tree to buy and sell stocks and bonds. The Buttonwood Agreement, signed by 24 stockbrokers, formalized this gathering and laid the groundwork for what would become the New York Stock Exchange, NYSE. As the U.S. economy grew and industrialized in the 19th century, so did the financial activities taking place on Wall Street. The rise of big businesses, railroads, and corporations increased the need for capital, and Wall Street became the place where investors could buy shares in these growing companies. Over time, Wall Street became a symbol of American capitalism and a center of financial power. The development of stock markets, investment banks, and financial institutions in the area turned it into the global financial center it is today. However, Wall Street's rise was not without its challenges. The 19th century saw financial panics and economic downturns, but these crises only reinforced Wall Street's importance in managing and directing capital. By the early 20th century, the area had become the heart of global finance, drawing investors and financial professionals from around the world. Today, Wall Street remains a symbol of financial power, and the institutions that began there have grown to play a significant role in the global economy. The rise of Wall Street marked the evolution of finance from local trading to a global interconnected financial system. Chapter 9: Panic. Throughout history, financial panics have been a recurring feature of the economy. These crises often arise from fear, uncertainty, and a sudden loss of confidence in the financial system. One of the most significant of these was the Panic of 1907, which deeply affected the U.S. economy. In this panic, a series of bank failures and stock market crashes triggered widespread fear and led to a massive withdrawal of funds from banks. The panic caused the economy to come to a standstill, and many businesses faced bankruptcy. The financial system was on the brink of collapse. The Panic of 1907 exposed the vulnerabilities in the American financial system, particularly the lack of a central institution to manage crises. During the panic, J.P. Morgan, the famous banker, played a pivotal role in stabilizing the economy by using his wealth and influence to restore confidence in the banking system. However, the crisis also revealed a critical need for a more structured, coordinated response to financial instability. The aftermath of the panic led to significant reforms, and many argued that the U.S. needed a central bank that could step in during times of crisis to prevent future panics. This event, among others, spurred a national debate on how to fix the financial system and ensure that such a panic would never happen again. Chapter 10: The Invention of the Fed. The Panic of 1907 played a major role in the creation of the Federal Reserve System, or the Fed, which remains one of the most important institutions in the U.S. economy today. In response to the financial instability revealed by the panic, the U.S. government decided to create a central bank that could manage the country's money supply, regulate banks, and act as a lender of last resort in times of crisis. The idea for the Federal Reserve came from a series of proposals and discussions among financial experts, bankers, and politicians. In 1913, after years of debate, President Woodrow Wilson signed the Federal Reserve Act into law, establishing the Federal Reserve System. The Fed was designed to provide a stable and flexible monetary system for the United States, capable of responding to economic fluctuations and financial crises. The system was built with 12 regional banks, each serving a different part of the country, along with a central board that coordinated their actions. The creation of the Fed marked a significant shift in the way the U.S. managed its economy, moving away from a decentralized system of banking to one that had a central authority with the power to influence national economic policy. The Federal Reserve was tasked with regulating the banking system, controlling inflation, and fostering a stable financial environment. Its role in managing the money supply and controlling interest rates has made it a key player in shaping the U.S. economy. While the creation of the Fed was a major step in stabilizing the financial system, it also brought its own challenges and controversies. Over time, the Federal Reserve would play a central role in responding to economic downturns, managing inflation, and guiding the U.S. economy through the complexities of global financial markets. The invention of the Fed transformed the financial landscape of the United States and marked a critical moment in the history of money and banking. Chapter 11. The invention of checking accounts. The invention of checking accounts revolutionized the way people managed their money. Before checking accounts, most people kept their money in physical form, coins, and paper currency, storing it in safes or at banks for security. But with the rise of businesses and more complex financial systems, people needed a way to make payments without carrying large amounts of cash. In the 19th century, merchants and businesses began to write notes that represented money, which could be exchanged for goods or services. These notes were essentially early forms of checks, promising that a certain amount of money could be withdrawn from a bank. Over time, the process became more formalized, and banks started offering accounts where customers could deposit money and write checks to make payments. By the early 20th century, checking accounts became widespread, allowing individuals and businesses to conduct transactions without needing physical cash. Checks provided a convenient way to transfer money from one account to another, and soon the system evolved to include checkbooks, which made writing checks even easier. The introduction of checking accounts not only made payments more efficient, but also contributed to the rise of modern banking. As people began to trust banks with their money and embrace the convenience of checks, the financial landscape changed. The invention of checking accounts allowed people to manage their finances in a way that was simpler and more secure than ever before. Chapter 12, The Great Depression. The Great Depression, which began in 1929, was one of the most severe economic crises in modern history. It was triggered by the stock market crash, like when the value of stocks plummeted, leading to widespread panic and a sharp decline in wealth. As people lost their savings and jobs, the economy spiraled downward. Unemployment soared, businesses closed, and banks failed as people rushed to withdraw their money, fearing further losses. The Depression highlighted the fragility of the financial system and the devastating effects of an unregulated economy. The banking system, in particular, was badly shaken, with over 9,000 banks failing during the 1930s. The stock market crash and its aftermath exposed the deep flaws in the economy and the need for government intervention to stabilize the financial system. In response to the Great Depression, the U.S. government took unprecedented steps to restore confidence in the economy. President Franklin D. Roosevelt introduced the New Deal, a series of programs and reforms aimed at providing relief to the unemployed, stabilizing the economy, and preventing future financial crises. Among these reforms was the creation of the Federal Deposit Insurance Corporation, FDIC, which insured bank deposits and helped restore trust in the banking system. The Great Depression also led to the introduction of stricter regulations on banks and financial markets, which reshaped the role of government in the economy. While the Depression caused widespread hardship, it also led to the development of policies that aim to prevent such a catastrophic event from happening again. The legacy of the Great Depression can still be seen in the financial regulations and safety nets that exist today, designed to protect people from the kinds of economic collapse that occurred in the 1930s. Chapter 13, The Invention of the Mortgage. The mortgage is a financial product that has become a staple of modern life, allowing people to buy homes and property without needing to pay the full price up front. The invention of the mortgage dates back centuries, but its widespread use began in the 19th century as the need for housing and property ownership grew. Before mortgages, most people had to save up large sums of money to buy land or homes, which was often not possible for the average person. The idea behind the mortgage was simple. Lenders would provide a loan to the borrower, who could then use the loan to buy a house or land, with the property itself serving as collateral. If the borrower failed to repay the loan, the lender could take ownership of the property. This allowed people to borrow money to purchase property while spreading the cost of the loan over many years, typically with fixed monthly payments. In the United States, the use of mortgages grew significantly in the 20th century. As urbanization and home ownership became more common, government backed programs such as the Federal Housing Administration, FHA, helped make mortgages more accessible to the average American. The mortgage system allowed families to build wealth by owning property, and it became a key part of the American dream. The widespread availability of mortgages also played a central role in the growth of the real estate market and the overall economy. The invention of the mortgage transformed the way people viewed homeownership and reshaped the financial landscape. Chapter 14: The End of the Gold Standard. The gold standard, a system where currency is directly tied to a specific amount of gold, was a cornerstone of the global financial system for over a century. Under this system, countries could only print as much money as they had in gold reserves, providing stability and trust in the value of money. However, the gold standard had significant limitations, particularly in times of economic crisis. During the Great Depression, the rigidity of the gold standard became increasingly problematic. As countries struggled with economic downturns, they needed more flexibility to manage their money supply and respond to the crisis. In 1933, President Franklin D. Roosevelt took the dramatic step of abandoning the gold standard domestically, allowing the U.S. government to print more money to stimulate the economy and recover from the Depression. The final blow to the gold standard came in 1971, when President Richard Nixon announced the suspension of the US dollar's convertibility into gold, effectively ending the gold standard for good. This decision was made in response to inflationary pressures and a growing trade deficit, which strained the US gold reserves. With the end of the gold standard, the US dollar became a fiat currency, meaning its value was no longer backed by physical gold, but rather by the government's promise to uphold its worth. The end of the gold standard marked a significant shift in the global financial system. Without the constraint of gold reserves, governments gained more control over their money supply, allowing them to implement policies like adjusting interest rates and managing inflation. However, it also led to concerns about inflation and the stability of currencies. Despite these challenges, the abandonment of the gold standard paved the way for the modern, flexible financial system that we have today. The end of the gold standard was a critical moment in the history of money, changing how countries manage their economies and shaping the financial landscape of the future. Chapter 15: Inflation and the Fall of Bretton Woods. The Bretton Woods system, established in 1944, was designed to bring stability to the post-World War II global economy. It created a system of fixed exchange rates where currencies were tied to the US dollar, which in turn was convertible to gold at a fixed rate. This system provided a sense of stability, facilitating international trade and investment. However, by the 1960s and 1970s, the US economy was facing significant pressures, particularly rising inflation, which destabilized the Bretton Woods system. The rise of inflation in the United States, driven by factors like the Vietnam War and domestic spending, led to an increasing strain on the gold reserves that backed the dollar. Countries around the world began to question the US's ability to maintain the dollar's value in gold. As inflation continued to rise, the dollar weakened, and many countries began converting their dollars into gold, which led to a depletion of U.S. gold reserves. This created a crisis of confidence in the Bretton Woods system. In 1971, President Richard Nixon made the historic decision to suspend the US dollar's convertibility into gold, effectively ending the Bretton Woods system. This decision, known as the Nixon shock, led to the collapse of the gold-backed dollar system and marked the end of the Bretton Woods era. From this point onward, currencies around the world were no longer tied to gold, but instead became fiat currencies, with their value determined by supply and demand and government policy. The fall of Bretton Woods was a turning point in the history of global finance, shifting the world to a more flexible and less predictable monetary system. Chapter 16: The Mystery of Japan's Lost Decade. In the 1990s, Japan experienced what has come to be known as the Lost Decade, a period of economic stagnation that lasted well beyond 10 years. Despite being one of the world's largest and most advanced economies, Japan faced a series of challenges that led to a prolonged period of slow growth, deflation, and high unemployment. The origins of the lost decade can be traced to Japan's economic boom in the 1980s, when the country experienced rapid growth, fueled by speculative investments in real estate and stocks. However, this boom was unsustainable, and by the early 1990s, the bubble burst. Real estate and stock prices crashed, leaving businesses and banks with bad debts. The Japanese government and central bank responded by lowering interest rates and attempting to stimulate the economy. Yet, despite these efforts, Japan struggled to recover. One of the key problems was the banking sector's massive non-performing loans, which prevented banks from lending and companies from investing in new growth. The government's slow response to address these issues further prolonged the crisis. Another challenge was Japan's aging population, which created long-term structural problems. As the country's population shrank, there were fewer workers to drive economic growth, and the economy became burdened with an increasing number of retirees. Japan's lost decade was marked by a series of missed opportunities and policy mistakes that left the economy mired in stagnation. Despite the challenges, Japan did not experience the same kind of total collapse seen in other nations facing similar economic crises. The lost decade, however, has become a cautionary tale for other economies. It showed how speculative bubbles, combined with slow responses to financial crises and demographic challenges, could have long-lasting effects on an economy. While Japan eventually regained stability, the lost decade continues to be a reminder of the complexities of economic recovery and the dangers of unchecked financial exuberance. Chapter 17: The 2008 Financial Crisis. The 2008 financial crisis was one of the most significant economic events in modern history, deeply affecting global markets and economies. It began in the United States due to a combination of risky lending practices, the bursting of the housing bubble, and the excessive use of financial derivatives. Banks and financial institutions eager to profit from the booming housing market gave out risky subprime mortgages to borrowers with poor credit. These loans were often bundled into complex financial products and sold to investors, creating a web of interconnected risks. As the housing market collapsed, home prices fell, and many homeowners could no longer afford to pay their mortgages. This triggered a wave of defaults, causing the value of mortgage-backed securities to plummet. Major financial institutions, which had heavily invested in these securities, began to face enormous losses. The collapse of Lehman Brothers, one of the largest investment banks in the US, in September 2008, marked a tipping point, sending shockwaves throughout the global financial system. The crisis led to widespread panic and a credit freeze, where banks stopped lending to each other and businesses, resulting in a severe economic downturn. Stock markets crashed, unemployment rates soared, and many businesses failed. In response, governments around the world took swift action, injecting capital into banks, bailing out key financial institutions, and implementing stimulus programs to stabilize the economy. The 2008 crisis exposed the weaknesses in the global financial system, including the dangers of unregulated lending, excessive risk-taking, and the interconnectedness of global markets. It also led to significant changes in financial regulations with new laws aimed at preventing future crises. While the world eventually recovered, the 2008 financial crisis left a lasting impact on public trust in financial institutions and highlighted the need for more robust oversight of global financial markets. Chapter 18: The Rise of Bitcoin. In 2009, a mysterious figure known as Satoshi Nakamoto introduced Bitcoin, the world's first decentralized cryptocurrency. Bitcoin was designed to be a digital currency that could be transferred and exchanged directly between people without the need for banks or intermediaries. Unlike traditional currencies, which are controlled by central banks, Bitcoin operates on a decentralized network called blockchain, where transactions are verified and recorded by a network of computers across the world. The rise of Bitcoin marked a significant shift in the way people thought about money. It offered the possibility of a currency that was not subject to the control of governments or central banks, which appealed to those who were dissatisfied with the existing financial system. Bitcoin's value started to rise as more people began to adopt and use it for transactions, investments, and as a store of value. Bitcoin also gained attention as an alternative investment, with its value fluctuating wildly over the years. Its decentralized nature and the technology behind it, blockchain, sparked interest in other cryptocurrencies and the development of new blockchain applications. However, Bitcoin has also faced criticism and challenges, including concerns about its volatility, scalability, and use in illegal transactions. Despite these issues, the rise of Bitcoin has had a profound impact on the financial world, pushing the boundaries of traditional finance and leading to the emergence of a new era of digital currencies. Bitcoin's success has inspired the creation of thousands of other cryptocurrencies, and the underlying blockchain technology has found applications in various industries, from finance to supply chain management. While Bitcoin's future remains uncertain, its rise has undoubtedly changed the way we think about money, banking, and the potential for decentralized financial systems. Chapter 19: The Future of Money. The future of money is rapidly evolving, driven by advancements in technology, changing societal needs, and global economic shifts. As the world becomes increasingly digital, traditional forms of money, such as cash and even physical credit cards, are gradually being replaced by digital currencies and payment systems. Cryptocurrencies like Bitcoin, along with central bank digital currencies, CBDCs, are at the forefront of this transformation. These digital forms of money offer greater convenience, faster transactions, and the possibility of a more inclusive financial system. One of the key factors shaping the future of money is the rise of blockchain technology. By providing a secure, transparent, and decentralized way to record transactions, blockchain has the potential to revolutionize how we handle payments, contracts, and even voting. This technology could eliminate the need for middlemen, such as banks and payment processors, reducing costs and increasing efficiency in financial transactions. Another significant trend is the increasing role of artificial intelligence and automation in financial services. AI is being used to improve everything from fraud detection to personalized financial advice. With machine learning algorithms, financial institutions can better predict market trends, assess risk, and offer tailored products to consumers. This could lead to a more personalized and efficient financial experience for individuals and businesses alike. At the same time, there are concerns about the future of money. Issues such as privacy, security, and the potential for financial exclusion are crucial challenges that need to be addressed. While digital currencies offer new opportunities, they also raise questions about government control, surveillance, and the stability of financial systems. There is also the risk that the shift towards digital money could leave certain populations behind, particularly those without access to technology or banking services. The future of money is likely to be a blend of old and new, with traditional financial systems adapting to the digital age. We may see the continued rise of cryptocurrencies alongside government-backed digital currencies, creating a diverse and complex financial landscape. As technology continues to reshape the way we use and think about money, the key will be finding a balance that offers innovation and convenience while ensuring security, inclusivity, and stability. The future of money is not just about the form it takes, but about how it is used to improve the lives of people around the world. If you liked the video, don't forget to hit the like button, drop a comment, and subscribe so you never miss out on upcoming content. I can't wait to hear your thoughts and bring you more awesome videos soon.